Let me introduce both of you. Today on today's webcast, we have both Adam Turnquist and Stephen Bernstein, and we're going to be taking a look at the mid-year outlook and where we're headed. Now, just for those of you in attendance, remember, this is not financial advice. This is for informational purposes only, and there's no solicitation as any part of this webinar. Now, we're really excited about hearing what both of you have to say. I think it's a really timely and it's an interesting topic. It's interesting times we're in now. And I guess Stephen, Adam, thank you very much for joining in. And Stephen, I'll let you start the presentation.
Perfect. Thank you so much. Welcome everybody to a mid-year outlook 2025, the most hated V-shaped rally. I'm super excited because not only am I getting to do another technicals with my good buddy Adam Turnquist, but he happens to be right next door. He's in my office for the day. We have a client appreciation event going on later on today, and he was very gracious to fly out here and to participate. So thank you for being here.
Oh, yeah, thank you for having me.
Yeah, of course, always. So Stephen Bernstein, I'm president of Stonewater Financial. There's three guided principles that I really live by when working with individuals and also small businesses. It's being comprehensive, integrity, and transparency. These are not just words to me; they mean something, and I really try to help engage, understand, and navigate people through their financial lives. The people who I do work with are individuals, families, employees, retirees, really a lot of different types of people who are in different phases of their career. Some of them are just starting off, some of them are in the middle of their career, or even exiting their career. And what I really try to do is just better understand what their goals are, what their objectives are, and be a soundboard to help them identify issues, figure out how to solve those issues, and create a plan. And I think creating a plan is necessary in order to get where you want to be. A lot of people just, fly by the seat of their pants. They just go day to day. They don't really know where they want to be. But by putting something on paper, by actually looking at the numbers, by identifying what those buckets are and when you need the money, that really helps you put something that is in your head down to paper and make it a reality. So hopefully you'll help me help you guys make realities and get to where you need to be. I'm super excited because we have two actual new programs that we're launching here at Stonewater Financial. One is for estate planning. I'm one of those individuals that like to procrastinate sometimes. And when it came to estate planning, I thought it was very difficult for me to come up with a plan. I have three kids, a beautiful wife, and we have, some assets, which is nice. But overall, what ends up happening is we don't understand who we want. It's hard for us to identify who we want to take care of our kids, who we want to maybe step into our shoes, because we're the ones who do everything from financials to building net worth to buying a house to retirement, all those different goals that we have. And it's super important to not only identify what those goals are, but to protect it. So we have a new program that we just launched, estate planning, where you can literally go in, takes you about 15 to 30 minutes, plug in all the information, and at the end, you'll have a robust estate plan that works for you. This is really for someone who doesn't have a very complicated estate. When some people have a more complicated estate, we can sit down, we can discuss it, we can figure out other alternatives. But this is a very easy way for someone who's just getting started to have something instead of nothing. So I truly think I'm excited about the program. I think it's very cool, and it's a very easy and streamlined program that is very actionable. Second program that we're launching today is actually Divest. It's where you're do-it-yourself investors. A lot of investors like to have the control of buying, selling stock. They need advice, they want advice, but when it comes down to it, what they really do is they just want to be able to push that button on their own. So Divest is a new program. It's not fully launched yet. It's coming soon, but it's a way for you not only to have access and to Adam, to myself, to other portfolio managers who know much more than I do, and hopefully more than you. But you can show your portfolio, show what you own, figure out like, do I have too much in one sector? Is it in line with what's going on economically today? All the different questions that we have that may help you in identifying what to hold and when to get rid of something, or maybe to add exposure to a specific holding. So I'm super excited about that. Um, Now let's go through like this state of economy. So this has been the most hated V-shaped rally. And if you see from the past 10 other times when we've experienced a 30% decline, there's a lot of times where the fear factor, things get boiled up, your emotions get the best of you, and you make the irrational decisions. And I think this was one of the best when it came down to it, because there's so much of a backdrop. There's so much going on social media. There's so much unrest that we really didn't feel comfortable putting money to work. And you saw it very much when it came down to institutions and retail. Institutional investors were actually like raising cash and selling, but retail was actually buying. So I don't know which bucket you were in. Hopefully you had the chance of buying at the dip, but this has been a very hated rally for many, many reasons, which we'll get into in a little bit. And hopefully you'll find some help in navigating the rest of the year as well from all that Adam and I have to share for today's webinar. So Adam, I'm going to turn it over to you to take over, and I'll add different comments along the way.
All right, thanks, Stephen, and thanks for having me in your new office. It's great to be out in person and doing a webinar with you, and then of course the client event. So it has been an interesting year to say the least on the macro. We've gone through a lot. A new president came in. We had tariffs announced on steel and aluminum. We had the reciprocal tariffs announced. We had those paused. We had a lot of uncertainty. It is really what it boils down to. And the market hates uncertainty. You can see that near bear market decline on the S&P 500 from a record high on February 18th, dropping precipitously into those April lows. And it caught a lot of people off guard. We didn't know what the tariff outcome would be, what that number in terms of the effective tariff rate would be. So it was kind of one of those sell now, ask questions later attitude. And I think a lot of people were caught off guard by this recovery. Now, history tells us V-shaped recoveries are the outlier, not the norm. You can see that through several of these experiences throughout the last almost 100 years here of data. A lot of times you go back, retest those lows. We look at things technically. It's often considered the norm is a bottom is a process. It takes time. You retest the lows. It's not a V-shaped recovery. Well, you have to be open-minded to a V-shaped recovery because we certainly got one. We retraced the decline. Now we're back to record high territory. Some of the layers of uncertainty have been removed. We had that pause that really kicked off the rally. And now we've sequenced from the sticker shock of the actual tariff rate to trade negotiation, now to trade deals. We've got the One Big Beautiful Bill Act, which we'll talk about in a minute. So we're starting to progress here to more positive catalysts for the market as we look ahead to the second half. Arguably, on a short-term basis here, we're a little bit overbought. Maybe there's room for some consolidation or a pullback, but hard to argue right now with the bull market continuing to print new highs.
Absolutely. And, it's doom and gloom. You have this fear factor, but overall, you have to go with the momentum. If things are going the right way, you have to, until evidence shows you to make a change in what your holdings are, don't make the change. Wait for the evidence to present itself.
Yeah, exactly. And one of the catalysts we've seen in that sequencing event is just going from more pro-growth policy, the One Big Beautiful Bill Act, a bit of a mouthful. So we'll call it OBBBA, or maybe you have a better, shorter acronym. Certainly, the market welcomed that news. It's another one of those events that removed uncertainty. We extended the 2017 tax cuts. There's a little bit of everything in that bill for everyone. When you look at the components of it, whether that is on some of the interest rate expenses for small caps, whether that's some of the tax incentives, even on things like tips, Social Security, market welcoming that news. Obviously, it's an expensive bill, but there's some pretty exciting growth components from a market perspective. And you can see some of the costs that you highlight here on the actual expenses. We're looking at how much that's going to increase our deficit due to the Big Beautiful Bill Act, but as we'll talk about in a minute here, there's some offsetting factors to that as well.
Yeah, and the truth is, with tariffs, that may alleviate some of this tax spending in the front end. So we're collecting a significant amount of tariffs, which could offset some of the spending that we are assuming in the front end from 2025 to like 2029, 2030. But you can see that both the House and the Senate really were pretty close to the same ending, that they wanted upfront in spending, and then at the end afterwards, after like 5 years, maybe some Reaganomics, so to speak, where you have some trickle down effect, where you have higher spending now and savings later on.
Yeah, certainly the long-term game there, and you can see revenues here. I just there was data released, I think it was today or yesterday, in terms of how much we're collecting in tariffs. July, a year-to-date high, I think we did almost 30 billion in tariffs. The annualized rate here over 300. I think some of the more conservative forecasts over the next 9 years, 10 years, we're looking at over $2 trillion in terms of revenue generated to help offset some of the deficit spending. I think there's a lot of debate over the what tariff revenues will look like, what the actual tariff rate will be, where the deficit goes. But I do think the market is at least welcoming to a degree the fact that we're addressing, or at least looking at the deficit in a serious way. Maybe there's more room to cut spending, not a popular topic, of course, but it's not being ignored, we'll call it. And I think that's probably a good sign. And I don't think the deficit as a concern will go away anytime soon. So tariffs certainly helping here.
Yeah, it's worth watching, because the EU just came up with $650 billion that they're going to end up spending here in the US, which is quite interesting. And the tariffs obviously were much higher. I think they mentioned like 20% originally, and then they dropped it to 15. But ultimately, like, that's a win. And we really have to watch it closely, because the more wins that we have with tariffs, the more the economy will continue to grow. The question really is what is that governmental piece? What is that geopolitical risk that we have, and how does it affect longer term relationships?
Right. And we're not seeing the escalation factor. That's what we witnessed early innings in April when the reciprocal tariffs were announced. We had all kinds of numbers being thrown out, whether that's 50, 150% type reciprocal tariffs, whether it's China or the EU. That really scared the market when we start thinking about Chinese imports being taxed at 150%. That tone has changed. Now we're back to the negotiation table. Even with China, they extended the trade deal, the trade truce for 2 weeks. President Trump expected to make a decision on that shortly after we get some of the details from Treasury Secretary Bessent. There's still a big question mark, though. Where will tariff rates end up? Forecasts are all over. Low teens is probably a best case scenario, to call it 20% on more on the worst case scenario. So until we get some further clarity on actual, we have framework for trade deals. We have the numbers, for example, with Japan, 15%, the EU, 15%. What are the sectoral tariffs for semiconductors, pharma? We've seen some of the other ones with copper, for example. Those be higher than probably expectations. So it's still a lot of uncertainty in a market that is pricing in very, very low volatility. I think I'm surprised by where some of the volatility metrics that we look at are trading, because they're not reflecting this uncertainty on the macro backdrop. But I think, again, the market is welcoming the fact that we're not escalating on tariff negotiations. Things have cooler heads have prevailed, if you will. And I think that's enough right now for the market. So ultimately, what do tariff rates mean for the economy on a short-term basis, at least? When we flash back to April, we were talking about those high reciprocal tariff rates, kind of a worst-case scenario. Wall Street immediately took their numbers down for growth expectations. Recession probabilities went up to 50% for a lot of places. We've seen those numbers come down. Now recession probabilities at 35%. They started the year around 25%. Not a base case scenario. Consensus, not a base case scenario for us as well. When you look at what's going on in the labor market, the consumer is still doing pretty well. on the GDP forecasts, low 1% for the year is probably where we're going to get. Again, slowing, but still growing. We're not talking about a recession, even though recession risk is a little bit higher. It just, when you talk about tariffs, it's a tax. It does allude to slower growth and higher inflation. At least maybe that's a one-time inflation shock. We'll see how that all plays out next year when some of these tariffs actually get implemented and we get a better read on what CPI looks like and or the consumer price inflation or personal consumption expenditures.
Yeah, I love this slide because it's really like describes the anatomy of a recession, right? Like it's a wait and see. We got to wait and see what's going to be. Are the two lines, the blue and the black, going to get closer together, or are they going to continue to just bifurcate and go different directions? So I'm in the wait and see camp until evidence proves otherwise. I don't think that we can say that a recession is in the near future.
No, and when you look at the inflation trends, they're still constructive. We've had a massive change in the inflation landscape in the US coming out of COVID. When we were in lockup, we couldn't go out, there was a surge in goods inflation. You can see that on this chart. We're looking at CPI, so core consumer price inflation data, year over year. The blue bars are goods services. So think of those Amazon boxes that were showing up at your house in 2022 because you couldn't spend.
22, 20, 2050. You should see how many come in this every single day in my house.
Hey, consumer remains resilient. You can attest to it. And then the services inflation, how that has now changed as we unlocked. We were able to go out and spend money. There was that pent up demand that created a surge in inflation, not to mention the wage pressures that went up. No one wanted to go back to work. So, of course, you had to pay higher wages to get people back to work. And now, since then, we've been in a downtrend with inflation. So, we call it disinflation, still positive, but the rate of acceleration is slowing. The Fed wants to get this to 2%. We're on the right path. One of the hangups has been services inflation, and that's really due to housing. That's one of the biggest components of that services category. So owner's equivalent rent, we call it OER, has been pretty sticky. High frequency data, when you look at some of the rental rates and housing data, suggests that we're going to see that alleviate as we get closer to year end, and we'll start to see that services component come down. Now, the bad news is we're in the bottom right, you can see the goods inflation now starting to pop up a little bit. Now, that's marginal, contributing about 0.2%, we'll call it, last month, but something that investors need to pay attention to because we're trying to assess what's the actual impact on prices when we're talking about tariffs. We haven't really seen a lot of data show up. As you'll see on the next chart, though, there are early signs that some of the costs from tariffs are getting passed through to the consumer. Now, is this front running tariffs and getting ahead of the implementation? 1 month of data doesn't make a trend, but you can see some of the components in CPI, things like household furnishings, those jumped higher. Apparel, that has not contributed to CPI since, I believe, since March. It was a detractor in April and May. That jumped higher last month. Even things like toys, those toy prices moving higher. So I can attest to that with a 3-year-old and a 1-year-old and some birthday parties. They've certainly gone up, at least at Target, where I tend to shop for toys. So now again, we'll continue to monitor this data. That's what the Fed is doing. They're really trying to assess how much is getting passed on to the consumer, how durable is that trend as well. Is this a one-time shock? That's kind of the consensus view among economists, that inflation or tariffs represent just a one-time shock. They're not a sustainable trend in inflation. But it's early innings here, and that's why the Fed is still in wait and see mode. So you're not the only one, Stephen, that's
Right.
wait and see mode on the economy right now.
So are you on the higher for longer camp, or are you thinking that we go defensive? Like, what are your thoughts here? I mean, you do see used car sales that's actually improving since COVID, which is a good sign.
Yeah, so there's certainly good signs as well. I think it is wait and see mode. We'll hear. We heard from the Fed today. We're going to break that down in a minute, but it seems to be a lack of confidence from the Fed that inflation is going to continue lower. There's also concern about slower growth. So it's a balancing act for the Fed. I'm not envious to be in Chair Powell's position for many reasons.
Well, today he reported that
Right.
it's unchanged. So I guess he's a wait and see kind of guy as well.
Right. So when we translate inflation to the market, what does that really mean? Higher inflation tends to weigh on the multiple. Here's just an example of the average S&P price to earnings ratio. So we're looking at a valuation metric. So when price to earnings ratios are high, that's, north of 18, 19 times. We're trading at over 22 times forward earnings right now. Now, historically, that's very high. Top top decile type earning or valuation for the market. A lot of things need to go right when you're in that type of high multiple environment. Inflation needs to come down simplistically for the market to be able to absorb that higher multiple. And you can see throughout history, low inflation warrants a higher PE in general. Higher inflation tends to weigh on the multiple as you have a discounting mechanism in terms of future cash flows. I'm not going to get into all that, but it tends to weigh on valuations a bit more. And it pretty symbolic here in terms of the data set. So right now we're trending toward that 2% rate. I don't think we'll get there this year. The Fed doesn't have that in their forecast as well, but it's more of a next year story. And I think it's as long as we continue on this disinflationary path, that should be enough. Maybe we get one or two cuts this year, probably, by December. I think maybe the next cut coming in September.
Yeah. Well, we're definitely not cheap, but what's interesting is seeing the disposable income per capita, right? It seems like all of the corporations are their expenditures are just going up and spending a lot of money on AI, yet the actual consumer is actually like raising cash and having some disposable income. So it's pretty interesting.
Right, and that's the good thing, and what's helped this theme of a resilient consumer despite higher rates is the fact that consumers on average are earning more than inflation. So the wage growth that we've witnessed really since here 2019 in this data set has outpaced the rise in inflation, and that's really supported what we're seeing in the consumer side in terms of whether that's the retail spending, even on the equity market and how much households are investing in the equity market. That's been a big story. You can see here, CPI is up 24%. Sounds very hot since 2019. Now, of course, it's a huge jump, but context is always key when you look at this data because you've had disposable personal income per capita at 32%. So there's been a huge influx or inflow of disposable income supporting this market as well.
So does the average Joe have enough money to pay for those higher priced tariff induced costs, moving forward? I mean, I think that's the biggest question among retailers today. Like people are worried about things costing more if it's made in US instead of made in China, and for a good reason. But I don't know if we'll ever replace, aluminum and steel and all of those like really just cheap things that it just makes more sense to get it abroad than to do it here. But at least there's an additional revenue component to that, which may be helpful.
Yeah, and I was just looking earlier at average hourly earnings year over year, 3.7% last month. You look at where inflation is, we're still outpacing inflation, and until that changes, I think the consumer is overall in pretty good shape. Of course, the data can change, especially when you're implementing 15, 25% tariffs on imports. But for now, consumer seems to be all right. One of the big drivers here, the labor market, resilient. There's a few data sets on this chart. So let's start at the top, and this looks at the unemployment rate. Of course, like one of the most watched employment indicators for the Fed. You're at 4.2%. Now, it's very low unemployment. That's not to recession levels. The trend or trajectory of unemployment may be a little bit concerning. We're coming off, 50 plus year lows when we were in the 3% range, but very good unemployment rate. Weekly jobless claims, I think that's one item to watch for the investors out there. If you start to see those ramp up 270, 280, that's where you get to maybe more of a recessionary environment. But you can see here, they're averaging on a 4-week basis, 225,000. That's a very tight a very full labor market. So we've gone from labor market conditions that were extremely tight. We talked about inflation and how that ramped up coming out of COVID. No one wanted to work, so you had to pay people more to get to work. Well, that created a major imbalance and a major tightening in the labor market, and that's what we're showing on the bottom panel. That's job openings, labor turnover survey. We call it the JOLTS report, and it's just a ratio of the number of openings to the unemployed. So as that moves higher, that means labor market's tighter. And when it moves lower, that's loosening up. And we're right back to these kind of pre-COVID levels. I mean, this is a kind of the sweet spot for the Fed, who's trying to make policy that supports full employment. And this is a key indicator for the Fed. If you go back to 2022, why we were higher for longer, the labor market contributing a large amount to inflation. Last summer, we heard the Fed talk about the labor market being back in balance, and that was what the market was really listening to before they could start cutting rates as they did in September. So labor market is really not the problem for the Fed. I think it's the inflation side of their dual mandate that's keeping them up at night.
Yeah, and then the question I get this question all the time from clients, is AI going to replace my job? And it seems like right now job openings are fine, and people have jobs, and unemployment is very low. Now it is a lag, but that's why we're watching it to see where it's going to go from here.
Turning to the Fed here on monetary policy, they just wrapped up their July meeting as expected. They left rates unchanged. You had two people dissent from consensus, and they were wanting rate cuts. I think that's the first time the Fed, there's 12 voting members, have had two dissenters since the early 90s. So we kind of expected this. They've been vocal in terms of the Fed speaking circuit. They're out in the media talking about basically dissenting views from a hold. I just looked at the Fed funds futures market right now. Still looks like September is going to be the most likely scenario where we see a rate cut. And then December is a little bit more of a wild card, call it 50-50. And again, it's this wait and see mode for the Fed. If the labor market starts deteriorating, you'll see those rate cut odds increase, meaning the Fed will likely cut at least two times this year. But if the labor market's holding up and inflation remains sticky, I think you have to assume maybe one or two cuts this year for the Fed.
It's funny when I look at this chart, I actually think of like, who sunk? Did you sink my battleship? Like we're playing like a game where you have a line in between, and, and you got to pick like point. Yeah. F1.
Yeah, these are all the dots. So when you hear the dot plot, that's the visual of the dot plot. Another
Exactly.
point is just we're always trying to assess the health of the consumer. And one area we look at is just delinquency rates. We focus more on the serious delinquencies. So these are people that have not paid their credit card or auto loans after 90 days. So seriously delinquent. And here you're at 3% for autos, 2.5% for credit card. Now, they were higher back in the global financial crisis, but we're through COVID levels. Now, I don't know if COVID's a great example because the consumers were hit with stimulus checks. They were flush with cash. So I think the fact that we're higher than those levels, not surprising. But the rate of change here is a little bit alarming. You can see how these have ramped up significantly. When you get these surges in delinquencies, it tends to precede a recession. Again, not our base case, but some more data points to watch on the consumer side here.
Perfect. Let's climb the wall of worry, and we're gonna have to speed it up a little bit because there's a lot to get through.
Right. So this kind of looks like a wall of worry with the S&P. Talked about this V-shaped recovery, and it really started off a multi-year uptrend, and we got down to about 4,800 on the S&P 500 in April. That lined up with the 2021 highs and this uptrend that's been in place for a number of years. And it was really interesting to see the market challenge that level and buyers come in and support that major area. We had a impressive rally off the lows, one of the fastest rate of changes we've seen over this time frame, and get through the February highs in a matter of I think it was 60 some days, and now we're just grinding higher. We just wrapped up a 6-day record high streak for the S&P 500. Now, on a short-term basis, you can make the argument technically we're a little bit overbought, meaning we're a little bit extended. We've moved a little bit too much too fast. So what happens after that? You tend to get a pause or even a pullback. When we look at how many stocks in the S&P 500 are overbought, we're about 13%. That's the middle panel. The alarm bell starts going off kind of north of 20%. But when you're above 10%, you should be on alert for a pullback. The bottom panel is a momentum indicator that we look at called RSI. That hit 76 just recently. That's a statistically high level. So more evidence of maybe a little short-term pain, but when you have this much momentum and you backtest these type of recoveries, 12 months later, you're talking about above average, very high positive returns, positivity rates in terms of returns for the broader market. So the one-liner or the headline would be, some short-term pain, long-term gains, I think, for the S&P 500 makes sense.
Yeah, sentiment is still negative, which is a positive because the more the sentiment, if sentiment stays negative and isn't overextended, then this rally could continue. Seasonally, by the way, August and September are usually negative months. So I think seasonally we may see a perfect timing of a little bit of a pullback. But there's a lot of buyers out there and there's a lot of dry powder. So I guess we'll wait and see how that turns out ultimately.
One of the other metrics we look at when we assess a recovery or a rally to new highs, we want to see how many stocks are participating in the rally. We call it market breadth. So more robust, sustainable rallies have broad participation. It's not just narrow leadership, aka the mega caps, your Nvidias of the world. We've had a pretty narrow rally in July, at least the first half of July. It was a little concerning because the market kept going higher, but our breadth metrics that we were looking at were not expanding to levels that were commensurate with a record high market. Now, last week, we started to see the stocks broaden out. We're looking here at a scatter plot showing when the market's in record high territory, we define that within 3% of a record high. On the x-axis, how many stocks are above their 200-day moving average? So it's just one measure of breadth. Also, how many are making new 52-week highs? That's on the y-axis. So last Monday, we were about 60% above the 200-day, about 3% making new highs, even though the market was up 5 straight days at record highs. Pretty narrow breadth. Now, fast forward to Friday, we started to see breadth expand. You can see kind of where that average is in the middle, and we're moving toward that average for a market making new highs. We're starting to see other sectors participate, and the good news when you look at breadth, even though it's a little underwhelming, the composition of breadth remains more of the cyclical names, the growth-oriented names. So the leadership you want for a market making new highs, our internal trend model. I'm not going to get into the weeds here, but it's just in how we define trend within the market. You can see on the top right, 43% of S&P stocks in a confirmed uptrend. That's the strongest reading in the model. That compares to less than 20% in a confirmed downtrend. So again, the trend model looks very constructive. It's been very constructive really since May, and it's those cyclical, more growth-oriented sectors that are leading the way. You have areas like materials, technology, industrials, financials, all showing up very strong in our trend model. That's the leadership that points to more of a sustainable bull market than a market top.
Yeah, what's interesting is that earnings for this quarter are also like very positive. 80% have been beating expectations, or meeting, which is a good sign that this rally is not totally done.
Here's more evidence of the market broadening out. This is the equal weight S&P 500. I like to look at this chart because every stock, as the name suggests, has an equal weight. So we're taking out the NVIDIA impact. We're taking out the Microsoft impact. We're just looking at how the average S&P stock is doing. And we had this brief divergence with the cap weighted, the one that's been driven by those handful of mega cap names, rallying to new highs, the equal weight trading almost lower during that period. Well, we've had a resurgence in the average S&P stock here. It actually hit a new high last week. I think that's a good sign for more of a sustainable rally. Not quite outperforming in terms of the average stock, but certainly moving in the right direction here and aligning with this broadening theme that we're starting to see.
I guess I stole your thunder on this slide, but yeah, 82%. So I was off by 1%. Sorry.
Yeah, earnings have been pretty good. I would say is maybe even an understatement. When we came into the quarter, we had downward revisions. We were looking at maybe 5% earnings growth. Now we're north of 6%. Of course, we have some mega cap names, a couple of them reporting after the bell. That can change the narrative. Commentary, whether that's AI has been constructive, the CapEx spending, really unfazed. We had Alphabet come out, actually raise their CapEx from 75 billion to 85 billion for the quarter, or for the year. That's what the market wants to hear, that they're continuing to spend on AI. We're not going to get into whether the return on investment of that AI is being a factor yet. I think it's really about the spend. And then you go to more of the consumer names. Look at what Delta reported, for example. They've had a great read on the consumer going into 2023. The base case was a recession call. Ed Bastian, the CEO of Delta, basically said, "No way. Look what our consumers are doing." So I put a little more weight when they've got it right. And he was very constructive on the consumer. They're seeing fair demand come back and balance. They're seeing spending on the higher end type of products that they offer. A much different tone from him and from Delta from first quarter. There was a lot of uncertainty and concern about overall spending and the health of the consumer. That's changed. You had credit card spending do quite well. Consumers are out swiping still on their American Express cards. So a pretty solid earnings season so far.
Yeah, just to segue into fixed income, there's a rare opportunity to lock in attractive yields without having to reach very far out on the yield curve, which is interesting. So it seems like you know bonds have not been your friend for the last couple of years. I mean, they've been a terrible place to put money. In fact, I've been looking into other alternatives like structured notes, for example, for some of my clients that will give you some higher yields. And that obviously depends on if it's appropriate for your specific situation. But it's looking better and better. The question really is it longer, higher for longer or not, and how that maybe we do see some cuts, maybe at the end of the year, maybe not until next year. But how does that impact the longer end of the curve?
Well, on the long end, if we see cuts, arguably the long end should come down. Now, how does the market perceive those cuts? Are we still worried about deficits? We look at what's called the term premium, and that has remained stubbornly high. We're talking multi-year type highs for term premium. That's the added yield investors require for taking on duration risk. So there's I think, some deficit concerns baked. Part of that is the deficit. Global yields are another factor. A lot of global yields are moving higher, longer duration global yields moving higher. So there's a gravitational pull on some of those, on other sovereign rates pulling the long end higher.
Right,
Now,
but globally they're cutting rates, right? So globally they're cutting rates already. So they've already started that process.
there's one exception, and that's the Bank of Japan, and that's one that has acted as a safe haven. And not a lot of people were investing in Japan because of their ultra low policy rates. They're extremely low. They've been the outlier in all of this rate cutting because they were trying to stoke sustainable inflation in Japan. They're starting to get that, and now the narrative has changed from ultra low rates to rate hikes, even though they're marginal compared to where the Fed is. That's attracting flows back to Japan. It's putting a bid back into those Japanese government bonds and putting some pressure on the long end of the curve. The good news for investors, though, for fixed income right now, you don't have to take on duration risk. You don't need to go out 30 years, 15, 20 years to get yield. You don't have to take on high yield credit right now because spreads are historically tight. So you can get pretty attractive yields in the fixed income market without taking on that added risk. You can go into things like treasuries, agency mortgage-backed securities that offer very attractive yields relative to the last, call it 15 years. And you clip some nice coupons right now, it's exciting to talk about if you're our chief fixed income strategist who likes to say bonds are back. Shout out to Lauren for that.
I think I need a shot of whiskey in order to go through that conversation.
Yeah, as someone that worked on a fixed income desk trying to sell 2% yields, 20 years out, it's nice to see some coupon out there.
For sure. So let's go into the dollar. Like, what does a weaker dollar mean?
So we've had a rebound in the dollar. This is a major inflection point for the dollar index here. This is a very long-term trend going back to the '08 lows. And we've had a very rough start to the dollar for the year, down over 10%, the worst start to a year since inception in 1973. Interestingly enough, we've had a bounce off this secular uptrend. The dollar very oversold. One of the most crowded trades out there in the macro landscape is short dollar. So we're getting a big relief rally the other way on the dollar. We'll see where that lands and how sustainable it is. I think this is going to be a big factor in how we think about international allocations. A weaker dollar tends to support international markets. They tend to outperform, especially emerging markets. So they're sensitive to the dollar in both directions. Right now, we'll see how the dollar shakes out in terms of holding this support level. I think you have to give this longer term trend the benefit of the doubt. What does that mean for US equities? Well, tech, interestingly enough, has the most exposure to global revenue. So 58% of the tech sector has revenues abroad. A weaker dollar is good for them because they can repatriate their international revenue, tends to give an earnings boost to those tech companies. So it can weigh a little bit on the tech sector in terms of US allocations.
Yeah.
One of
And what is
the
the alternative, right? So is there alternative to the dollar?
This is the ultimate Tina trade, as we call it. There is no alternative.
There's no alternative.
We get a lot of questions, and they're valid questions when the dollar's down 10% in the first half of the year, right? You have a cryptocurrency rallying, you have potential alternatives there. But when you look at the dollar and you compare it, what's the use case? Obviously, it's the most widely used currency in global trade, the most widely held currency in reserves. There's really no alternative. You can look at 58% of central bank reserves are in the dollar. Now that's come down, but still the nearest competitor is the euro at 20%. And this is trillions of dollars we're talking, in terms of overall reserves. Half of international transactions, according to SWIFT, are done in the dollar. So for an alternative to kind of dethrone the dollar, there's really nothing right now. Now this can change, and history will tell us that currencies throughout the last hundreds of years have changed in terms of the call it a main currency. But for now, at least our forecast is that the dollar remains alive and well as the world's reserve currency.
Yeah, it's actually interesting because stablecoin, a lot of stablecoin like Tether are buying treasuries to support or to backstop their cryptocurrency, right? Their stablecoins. So it shows that the dollar is getting weaker, but we do potentially have other alternatives besides gold and besides the dollar that may end up becoming something in the future. We don't know, but it's very big potential.
Yeah, huge potential. And gold seems to be the first course when you're trying to diversify your central bank reserves away from the dollar. Gold seems to be the number one choice. That could change, with the digital currencies, some of it becoming more legitimate with recent legislation in Washington. What's been really interesting, this is a chart put together by Christian Kerr, head of macro, that shows the relationship between the dollar index and real yields. We flip real yields around here. So as that orange line's moving higher, that's real yields moving lower, just so we can show the parallels here a little bit easier. And when real yields are lower, that's a catalyst. You go buy gold. That's been the play for, since call it '09, the GFC, and even longer. And what we witnessed is real yields moving higher. That's the orange line moving lower, but yet gold rallying. And that was confusing maybe at the time because that's not the normal relationship. We completely decoupled. That catalyst for that decoupling really started when Russia invaded Ukraine back in 2022. What US and Western allies started to freeze dollar reserve assets, several hundred billion for Russia, for example. That spooked some of the non-aligned Western countries. So they started to say, I don't want my reserves frozen. So I'm going to buy something that can't be frozen by the US government or its allies. So they started to buy gold. And in very big way. So they're more they're not as price sensitive. So as gold continue to rally, they continue to buy gold. That's been a big driver of the gold trade, which has outperformed equities last year, outperformed equities in the first half of this year. You can see gold prices just up and to the right there. I mean, you don't need to be a technician to see that trend.
It's not following monetary policy. It's following a geopolitical backdrop that's very interesting. It's a completely different way of looking at gold.
Yeah, and it's been a obviously a very good trade. When you look at how durable is this trend, if you go, I think on the next chart, what central banks are telling us around the world. So the World Gold Council does a survey every year. They ask all of these central bankers around the world, what are you doing with your assets in terms of reserves? And one of the questions that I like to look at is, are you going to add gold to your reserves, lower gold, or unchanged? And then the same with the dollar. And that's what we're highlighting. So go to 2022. That was when Russia invaded Ukraine. You have on the far right, 46% of central bankers said, I'm going to add gold to my reserves over the next 5 years. Fast forward to today and you look bottom right, 69%. So how are they going to buy gold? Well, you can look at the green chart. Lower dollar, 42%. That's gone to 62%. So this has been completely bifurcated. Basically, central bankers telling us over the next 5 years, we're going to be adding more gold and reducing our dollar exposure.
Interesting. And just in the mineral world, China has definitely been the leader. You see that from all these different minerals, rare earths, that their market share is 94% for yttrium and rare earths 74%. So there's definitely a push that it's called the America's First Mining Initiative that Trump initiated recently to try to spur some of those minerals here in the U.S. and not be so reliant on China for that. The question really is will that ripple effect turn into an escalation and like a China war with the U.S. And that's we'll see what happens there because they do have the power at this point in time.
Yeah, it's a good card for China at the negotiation table. And I said they've made progress on the rare earth negotiation. We'll see how that looks in 2 weeks when we hit that pause deadline.
Yeah, for sure. And what's interesting is that, you see MVP materials, you do see like some of those rare earths or mineral companies, like they're performing really, really well since that initiative got launched. So we'll see if that continues and how far that goes. I mean, I don't really see the US doing deep sea drilling because that environmentally will impact us in a negative way, which I don't think we want to be in the same predicament that China has when it comes to environmental studies.
Yeah, they're trying to clean that up as much as possible. They're shutting down different facilities due to environmental regulation, which is almost unheard of in China. If you told me that 10 years ago, I wouldn't believe it.
So let's talk about actionable ideas. Let's talk about what we can do from here.
Yeah. So a couple favorites from our house view, our strategic and tactical asset allocation committee. We call our stack view. Is communication services. That's been an overweight from at least over the last year. I can't remember exactly the date we went long, but certainly a favorite idea. You have a rally here to record highs. We recently just pulled back, so we think of those as pullback opportunities. Things got a little overbought. It's corrected back to a good spot for support. Thematically, we like the idea. You get some hyperscalers in there, but then you get some more telecom names. So we think of it as like a barbell. So you have kind of your growth or higher beta names in there versus some of more your defensive telecom type names. It's worked very well on the bottom panel. That's its ratio chart versus the broader market. When that's up and to the right, that means it's outperforming. It's been a very consistent outperformer for the last couple of years. We think that trend will continue.
Right. The big beautiful bill should be really helpful to financials. Our big banks should get a big boost from that, from what it looks like. So I'm a big fan of financials here. I think that regional banks and the big banks alike have a significant amount of capital on hand, and they have to keep a lot of liquidity on hand. I think that makes it much more difficult for them to lend, and I think the lending standards will probably get more easy to do business for small companies, especially if there are some cuts by the Fed in this year or next year.
Right, and you look at some of the big banks, whether that's their trading revenues were very good this quarter, obviously benefiting from the volatility we witnessed, but on the investment banking side, their fees have surprised to the upside, and that's another factor in terms of the administration being more pro-growth, less regulation. That does open up some of the M&A space a little bit more deals getting done. Low volatility also helping, at least coming out of the reciprocal tariff day, helping those investment banking deals get done. Couple others. Got to talk about tech. Obviously, led the market into the lows in April, leading the market out of the lows, up considerably since April. But I look at this chart and I really think of it as just breaking out. It's just getting through the July 2024 highs. That was a big area of resistance throughout last year and early or late last year. We're now breaking out to new highs there. On a relative basis, we're breaking out versus the broader market. Participation in the sector, when we look at how many stocks, again, that breadth component are included in this rally, it's been very broad. Big driver there has been this semiconductor space. That's the biggest sub-industry group weighting. And when you think about your tech allocation, it's usually a question of, do you want to own the sector or do you want to own components of the sector? That gets drilled down to software versus semiconductors. Now, last year, the trade was to be long software. That's starting to change, and this ratio chart is showing that change. As this is starting to move lower, that means semiconductors are outperforming. That trend is changing. We can see that in some of the trend models that we look at. There's we call it a DMI indicator on the bottom, suggesting this is a durable trend change. The semiconductor chart is breaking out as well. Again, it's not just NVIDIA. It's very broad-based buying pressure. And I think the read-through there as well for the broader economy, semiconductors, they're in everything, whether that's your car, your phone. It's hard to not be exposed to semiconductors. They're considered a leading economic indicator. And here they are in a very good cycle, starting to break out to new highs after a pretty long consolidation phase.
Energy has not been my friend in the last couple months. But when you're going back to when oil actually went negative, that was a great time to add exposure, and it's been a great trade for the last couple of years since COVID. So it really is only the last, like, let's say year and a half where things changed. And you're seeing that with oil prices at in the 60s now. I think 80s is the price that most people target for all energy companies or oil companies to actually make money. But overall, I think that we still need oil and gas for multiple reasons, and one of which is it actually is utilized for a lot of technology that we use today, and a lot of people forget that. So I don't see that solar is going to be a replacement for oil, and not in the near future. Maybe it may take over some market share, but it's not going to be the replacement because we use it every single day for so many different things that we need, including chips.
Right, exactly. And energy has just been stuck in a range. It had a phenomenal year leading up to that range, outperformed. You see these years where a sector will outperform sizably, then they'll consolidate for a while, and then they generally break out in the direction of the previous trend. In that case, to the upside here. Arguably, this is kind of what tech looked like last year, right? We had this big rally in tech sideways, and now we're starting to see the breakout. For energy to do it, we'll need to get through some more resistance. But I think the good news for the sector, technically, you can make the case that crude oil has found its lows around 55. There seems to be buying pressure around 65. We're not making new lows, really, despite the fact that OPEC plus, the oil cartel in the Middle East and Russia, is telling us they're going to keep trying to capture market share by adding more oils to the market. They cut their production quota to balance the market out last year. They've subsequently started adding more oil to the global market, and we're not making new lows. So I think that's a positive sign. I think of the trend here, and at least crude oil is probably just sideways. Maybe 65, 55 is the low end. Call it 80, 75, 80 is the upper end, which there's components in there where lift rates are for oil companies to keep drilling, and it's still profitable.
Yeah, I know we went through a lot of information. We have two more actual ideas, but let's go through this a little faster just so we can open up for questions. And healthcare has definitely been a laggard since RFK came into office. So and was appointed his position. So why don't we talk about biotech and then we can finish it off.
Yeah, we'll be quick on biotech. I think of biotech is arguably just a trade, right? So you have this kind of range bound market. You buy it when it's cheap, you sell it at the upper end of the range. We're coming off the low end of that range. There's some upside to this trade. It was very oversold. We've subsequently rebounded. Lower rates help biotech. You think of biotech companies, a lot of them don't make any money, so they have to go to the market to finance their operations. They burn their cash. So low rates help. It's considered a long duration asset. So if we see longer rates come down, that's going to help biotech. Some really interesting stuff when you combine AI in areas like CRISPR or messenger or mRNA, what they're able to do, at least over the next couple of years. There's some interesting price action in that area of biotech. But if you're looking at healthcare and you want exposure, I would start with biotech here.
Yeah, and lower rates also help home builders.
Yeah, a good segue. Another area of the market that was very beaten up, down almost 40% here on the home builders index. That's almost to the level that we witnessed in 2022. Down a little bit more, but we're talking about a bear market in home builders, kind of a stealth bear market here for the space. But we're looking for an inflection point technically, and they often occur at major areas of support. You can see going back to the 2021 highs, that's where buyers, interestingly enough, came in, started buying home builders. Now we're breaking out from this bottom. We still have the 200-day moving average to contend with, but I think technically you can make the case here. We've likely set a low. Looks like some decent upside for the home builder space, especially if we get longer duration to come down.
Yeah, awesome. So Eric, are you still around?
Yeah, yeah, yeah.
Did we put you to sleep?
No, not at all. This is a rare thing. This is very, very interesting. Um,
Let's open it up to questions and see if there's any. We have a couple of minutes left.
couple minutes. So for those of you in attendance, some of you have been writing questions. We have a Q&A panel at the bottom of the chat. So I'm going to go through a few questions. We'll try to get as many answered. If not, you're always welcome to send us an email. You have the QR code on your screen here if you'd like to talk to Steven or Adam or book a meeting with Steven. But let's go over a couple questions that I thought were interesting that people submitted throughout the webcast. Um, I guess first question is, you've given a good mitigated approach to the economy. We can either go upwards or be a little more stagnated. What are some of the metrics or the numbers that either of you would be looking at to have a clear idea where we're headed from here?
Adam, you want to start or should I?
So yeah, I think some of the metrics I tend to try to look at higher frequency data. I would note the weekly jobless claims are probably one that have changed over my career in terms of importance, especially right now. That's where you're going to see cracks emerge. Continuing claims, those are people that are continuing to file for unemployment. Watch those metrics, they're weekly for the labor market. And then I also like some of the survey data. I don't necessarily, for example, the Institute for Supply Management, we call it the ISM. They have a services and a manufacturing index. The commentary in those, they ask them different questions each month. There's some really good excerpts from those ISM data points, especially on the manufacturing side right now. We're looking at things like how much tariffs are getting passed through. What are you seeing in terms of price increases from your suppliers overseas? Those are things that I'm paying more attention to than normal in this environment.
I think for me, bonds are a leading indicator. I would follow rates and see where they're headed, and also like sentiment. You know, if sentiment starts to change and get like overly excited, then I may take a pause and maybe shave some of that risk off. But right now, the trend is your friend, and I think that um, watch Powell what he's going to do, and don't fight the Fed because it seems like until he pivots, it's pretty much unchanged for now.
Okay. And another question. So then this came up a couple of times in the chat. The I guess the U.S. administration did announce trade deals with both the EU and Japan in the past week. And I guess some of our attendees want to know what's your take on it?
So I would call it good news overall. How much of that was priced into the market? A lot. I think when you look at the reaction, the thing with tariffs and these deals, I there needs to be confidence they're not subject to change, and there's some shakiness around there, especially with Japan. If they don't live up to their investment that they pledged, they can increase that rate to 25%. There's just a lot of ambiguity on what that investment is. Their U.S. fund, how are they going to do it? What does it entail? Looks like a lot of loans that they can write, not so much actual investment. So overall, though, I think you can go nuanced as you want on these trade deals. The fact that we're not escalating and we're talking about reciprocal tariffs, that is the win for the market, and that's probably what matters most than any of the fine print, we'll call it.
Yeah, I agree. And the truth is, we really don't know what that number is. It's a win. We don't know how big that number will turn into. It may be much bigger than 600 billion. We have no idea. But I think the fact that President Trump was able to negotiate another tariff deal is pretty positive for where we're headed.
Perfect. Uh, we are on the hour. Stephen, do you want to, I guess, let people know how they can reach you?
Yeah. Hopefully you found this information was helpful in helping you guide through the market. We do expect the second half of the year to be different than the first half of the year. First half of the year was quite resilient and quite strong. Second half of the year may not be as strong, but we'll wait and see. Overall, September and August and September are seasonally tougher months, so I wouldn't be surprised if we see a dip. But overall, like, just make sure that you're waiting and be patient. And if you see some interesting areas to buy into and to add, buy the dip. Take some money off the sidelines and maybe add to exposure to certain areas that are actionable. So thank you for your time. Really appreciate it. If there's any questions that you may have, please click on the QR link and you can set up a time to speak to myself or to Adam. And looking forward to next time we speak. Have a great day.
Hey, thank you. Have a good one.
Thanks, everyone.